All right, let's get right into it. If you're in your 20s and you want a no-nonsense guide to building wealth in India, you are in exactly the right place. Let's dive into the blueprint. This right here, this is the whole game. Forget needing a huge salary. Your single greatest asset, your superpower, isn't money. It's the decades you have ahead of you.
So you're probably thinking, yeah, I get it, but a few years can't make that big of a difference, can it? Well, let me just show you something. The numbers tell a pretty wild story.
Okay, now check this out. It's kinda crazy. Ramesh invests for only 10 years, putting in a total of 6 lakhs. Suresh, on the other hand, invests for 25 years, putting in 15 lakhs. That's more than double the money. But look at the result. By age 60, Ramesh has almost 2 crores. Suresh has less than 1. The only difference? Ramesh started 10 years earlier. That is the insane power of compounding.
So before we go on the attack and start growing our money, we have to build a really strong defense. Think of it like a fortress. This first step is all about making sure your financial base is rock solid.
And the best place to start is with a super simple budget. The 50-30-20 rule is like Google Maps for your money. 50% for your needs, the stuff you have to pay. 30% for your wants, all the fun stuff. And that last 20%, that's the magic number. That's the slice we're going to use to build your entire future.
Now, with that 20% we've carved out, our first job isn't to chase some crazy high returns. Nope, it's to build a safety net. This is your emergency fund, and it's non-negotiable.
So what's the goal? You're aiming to save up enough cash to cover 3 to 6 months of your absolute essential expenses. Think rent, food, EMIs. This is your sleep well at night fund. It's what lets you invest without panicking if life throws you a curveball.
The other part of our fortress is insurance. Look, this isn't an investment to make you money. It's armor that stops you from losing everything. And getting it in your 20s is a total cheat code because the premiums are ridiculously cheap.
Okay, fortress is built, defenses are up, now for the fun part. Let's get on the offensive and look at the simple tools you can use to actually start growing your money.
For pretty much everyone starting out, mutual funds are your best friend. Don't let the name scare you. It's just you and a bunch of other people pulling your money together and hiring a professional to do all the hard research and stock picking for you. It's that simple.
So here's your starter pack. First, you've got mutual funds, using something called a SIP. That's just an automatic monthly investment. These are your engine for growth. Then you've got FDs for safety and any short-term goals. And finally, digital gold is a super easy way to get a piece of a classic, reliable asset.
So you've got the tools, but how do you put them together? Well, that brings us to maybe the most important strategy in all of investing, diversification.
You've heard this a million times, I know, but it is so important. Don't put all your eggs in one basket. That's it. That's all diversification is. It's your financial seatbelt. It ensures that if one part of your investment zigs, another part zags, smoothing out the ride.
And here's what that can actually look like. Now, don't treat this as a strict rule, but it's a great starting blueprint. You see, you have the biggest chunk in things that grow, like mutual funds, but it's balanced with safer things like debt funds and FDs. Do you even have a little bit of gold in there? This is how you build a portfolio that can handle whatever the market throws at it.
Okay, so you've built the fortress. You've got your tools, you've got your blueprint. Now are you ready for the payoff? Let's see what happens when you let time do its thing. This is where it gets really exciting. Just take a second and look at these numbers. A simple 5,000 rupee SIP, after 10 years, you've got a very respectable 18 lakhs. Nice, but this is where the magic happens. After 20 years, you're a crorepati. And if you just keep going for 30 years, you're looking at nearly 6 crores. That's what starting early and just being consistent can do.
After seeing numbers like that, the question isn't really if you should start, it's how do I start, like right now. So let's get to it.
I want to wrap this up with a stupidly simple action plan. You can do this in the next 5 minutes. No more excuses, no more, I'll do it tomorrow.
Here it is. It's just 3 steps. 1. Pick an app. There are plenty of great ones out there. 2. Do your KYC. It's all online, takes a few minutes. You just need your Aadhaar and PAN. 3. Start your first SIP. And you don't need 5,000. You can literally start with 500 rupees. That's it. You're an investor.
So, if you forget everything else from this entire explainer, please remember this. The amount you start with is way less important than the day you start. A small investment today is worth so much more than a big investment you plan on making someday. Seriously, think about that. The decisions you make this week, today, could be what your future self is most grateful for. Your biggest advantage is right now. The clock is ticking.